Today you are going to learn about the infinite banking concept. This easy-to-learn cash flow strategy will help you control your cash flow while giving you more leverage and liquidity throughout your lifetime. It is the chief cornerstone of a safe and secure financial foundation. Ultimately, it will allow you to maximize your savings and investments while drastically reducing any risk associated with market volatility and uncertainty. Let us examine the current financial system. Until recently, our financial system has been shaped by Wall Street, bankers, and the government. Today, our financial system is more global, yet it is still shaped by just a few markets and their central banks and governments. A decision in Europe or China can have unforeseen consequences within the U.S. financial system and potentially cause financial stress in your home, business, or place of employment. Market decisions are happening all the time that could potentially have negative consequences for every American if they are not prepared. Think about what is going on with OPEC's manipulation of oil prices and China's economic growth. Think about your household for a moment. How much of your money is in the global financial system? How much of your retirement is in assets like stocks, bonds, mutual funds, or real estate? What happens to your savings and retirement accounts when the next bubble bursts? What happens to your dreams and goals when tax rates increase or inflation triples? What happens to your business if deflation or stagflation gets out of control? Today, oil is about $50 a barrel. What happens to oil refineries and oil exploration when prices remain this low? These questions are difficult to answer because no one can predict the future. At Everyday Wealth, we have strategies that insulate your money from uncertainty caused by market manipulation. The infinite banking concept is all about insulating your money, capital, and investments from risk. Money and capital make the world go round. Both are either saved or borrowed. Money is liquid and can be spent immediately. So, what is capital? Capital can be defined as money or assets invested or leveraged to create more money or marketable assets. In other words, using your money to make more money. That is what the wealthy do. This is similar to investing in your 401k, individual stocks, or mutual funds. All the money in your account is at risk of losing its value or worse, becoming worthless, even zero. What if there was a way to protect your money and still have the ability to use it at the same time? There is. This has been the financial strategy the wealthiest families in America have used for generations to secure and advance their wealth. Families like the Rockefellers, the Morgans, and even Walt Disney have used this strategy to create their family legacy. Understand that you do not need their kind of wealth to use this strategy. What you need is the knowledge of the strategy. You can start right where you are. The first step to maximizing your income and savings is by minimizing and, more importantly, eliminating wealth transfers. Wealth transfers can be defined in two ways, planned and unplanned. Planned wealth transfers are those that arise from financial planning strategies that pass wealth from generation to generation. Unplanned wealth transfers are those that arise from undisciplined spending or a lack of financial planning. Almost all of us transfer a portion of our wealth away and out of our control, and we do this daily. Some of these transfers we know about, while others we have no idea are happening. The most substantial wealth transfer that most of us know about is through taxation by the IRS, in other words, paying our fair share. That means at least 35% of our income is being transferred beyond our control to the government. Another wealth transfer is from interest charges. In June of 2020, GoBankingRates.com compiled a blueprint of what the typical American spending, debt, and savings look like. The average credit card debt was $6,814. The average mortgage debt was $202,284. The average student loan debt is more than $20,000, and the average auto loan debt was $32,187. The typical American's average savings account, 35% had nothing, while 60% have less than $10,000. The average retirement savings for the typical American, 64% have less than $10,000, while only 36% of Americans believe they're ready for retirement. The percentage of Americans who are living paycheck to paycheck is nearly half at 49%. With this kind of debt, how is financial freedom possible? Well, let us show you how. Now, you may be one of those extraordinary people that pays cash for everything. We will get back to you shortly. We will show you how paying cash can cause you as many problems as going into debt. Hey, remember, cash is still a wealth transfer. And if you continue this practice, you will end up just like the debtor. But let us get back to where we are today. After paying taxes and interest on purchases, you still need to live your life and dream your dreams. Cars, vacations, new homes and home renovations, starting a new business, investing in a rental home, or whatever you may dream of doing usually comes in last in your financial plans. Lifestyle expenses are a considerable wealth transfer, at least 20% in most households, and in some cases as much as 60%. What's left for investments and savings? Not much, maybe 10% if you're lucky. All these wealth transfers, the $40,000 car, the $10,000 vacation, the 35% in taxes, they all have lost the opportunity to be used as leverage and make you more money. Capital that is now gone forever. Let us talk about your income as a concept. All the money that you will ever earn in your entire life is finite. What if somebody could write you a check for your entire income potential over your lifetime? What would you do with that money? Would you spend it? Would you invest it? Would you save it? Our hope is that you would save it and utilize it as capital in income-producing assets. But what kind of returns are we suggesting? Let us take a look. We have a 42-year-old male who wants to retire at the age of 65. He makes about $150,000 a year. Now, most employers will increase your salary by about 3% each year to stay ahead of inflation. He has $100,000 in savings, maybe in a 401k, an IRA, a mutual fund, or some other type investment account. That $100,000 is growing at 6%. You can see that at age 65, their entire income potential is over $4.8 million. If that $4.8 million has been put into an infinite banking concept account or asset, it would have a wealth potential of over $10 million. So, you're going to have to find new ways to minimize the transfer of wealth out of your personal finances, starting with how you spend and utilize your money. The first step towards financial freedom is to set yourself up with a strategy that gives you control, flexibility, liquidity, and contractually guaranteed return. The infinite banking concept gives you all of this, plus gives you the ability to compound your growth on earnings tax-free. The infinite banking concept is essentially utilizing the same dollar twice. How is this possible? There are 3 different ways you are currently running your household spending and investing. For that typical American we introduced you to earlier, they are borrowing to pay for large expenses, their lifestyle, or capital for their business. We call these people debtors. They work to spend. Their capital isn't working for them because they are unable to save. When expenses come up, they typically borrow money and slowly repay the loan using their future income. They always pay interest. This type of borrowing and repaying continues, but they are always working just to get back to zero. They have obligated the majority of their future paychecks to someone else. The traditional way that our parents and grandparents handle large expenses is that they save their money. When they have a sizable expense come up, they empty their savings to pay for it, or, quote, drain their tank. As savers move through their life, they continually fill their savings tank and then drain their savings tank every time they have a sizable expense. They drain their tank and return to zero. In this comparison, they are no better off than the debtor. They are still at zero. The third way is to be a wealth creator. These are people that save as much of their money as available. They collateralize their wealth when they need to make a big purchase. This is what the wealthiest families in America have done for generations. So, how does this work? Well, you may have already done this and not even realized it. If you've ever borrowed from your 401k or against your home via a HELOC, you've done just this. All you are essentially doing is collateralizing that asset and taking out a loan against it. The idea is simple. You build up equity in an infinite banking concept account or asset. It earns uninterrupted compounding interest. When you have a large purchase, or maybe even an investment, you use the account to secure the loan to make the purchase. You might be thinking, doesn't this just make us a debtor? Well, not if you do it the right way. This is where the how is more important than the why. The interest on your loan can be the same as the interest that you are earning on your savings, and you're still coming out ahead. How can this possibly be? It has to do with the difference between compounding interest versus amortizing loans. Let us take a look at this example. Let us say that you borrow $50,000 at 6% over 25 years. Throughout the loan, you will repay $46,645.21 in interest because the principal is decreased when you make payments. If you have that same $50,000 in a savings account that earns 6% interest over 25 years, you will earn $164,593.54 because the principal increases over the term as the interest compounds. So, you've earned a total of $164,593.54 in interest. Your loan interest is $46,645.21. The net gain to you is a whopping $117,948.33. Plus, the original $50,000 is still in your infinite banking account. Now, imagine if you just spent the $50,000. You'd be out the $50,000 plus the opportunity to earn all that interest. That's why being just a saver is not necessarily the best way to build long-term wealth. Different accounts can be used to apply this strategy. You can use a savings account or CD. You can use a qualified account such as a 401k, IRA, or mutual fund. You can even use your stock portfolio and take out a margin loan. You can also do a home equity line of credit. Or you can use permanent dividend-paying life insurance. When looking into the different ways to build cash reserves or equity, you have to look at 4 key characteristics. How safe is the account or asset? How liquid is the money in the account or asset? What is the typical guaranteed rate of return? How is that account or asset going to be taxed? Let's compare a savings account or a CD. It is a very safe account for most. It is a very liquid account. But what is the rate of return on the savings or CD today? Less than 1%. And ultimately, how is that taxed? Well, it is taxed as earned. So the more interest you earn, the more you are taxed. Qualified accounts are much better than 401ks, IRAs, or mutual funds. How safe is that money? Can you lose the value of your account? How liquid is the money? Can you get access to it whenever you want? Actually, you can't touch those accounts until 59.5 without penalty. What is the rate of return on those accounts? Well, if you're seeing the yo-yo effect of the market, it could be dismal. And how is that account taxed? It is taxed as ordinary income when you pull it out in the later years. If you look at a home equity line of credit, it's not much better. Can you lose the equity in your home? Well, of course you can. Anyone who went through the crash of 2008 knows that you can lose home equity. So when you put your money into your house, it is not very safe. How liquid is that equity? Can you get access to it anytime you want? Can you walk to your mailbox and swipe your ATM card to get some much-needed cash in a hurry? Cash-out refis take at least 10 days, if not 30 days, to close and get the money that you need. What is the rate of return in home equity? It is always zero. The home value may appreciate or depreciate with the market, but your equity will always return 0% interest. And how is that taxed? You can also use a margin account against your stock portfolio. But again, you have to consider how safe is your stock portfolio. Can you lose value? How liquid is that account? Can you get access to it any time? What is the rate of return on that account? And ultimately, how is it taxed? If you look at those four considerations, stock accounts won't hold up. If the portfolio drops by a certain amount, you can always get a margin call on your loan. The loan is due in full immediately. While many accounts may work with an infinite banking concept, some will be better than others. With dividend-paying whole life insurance, the life insurance company pays an annual dividend. That dividend is applied to your cash and is guaranteed. You never lose that money. From a safety standpoint, there is no better account. From a liquidity standpoint, the insurance carrier guarantees loans against that account. Your cash value is the collateral for the loan given to you by the insurance company. It is guaranteed and highly liquid. The typical rates of return inside a permanent life insurance policy are determined by the dividend that the carrier pays. Although the rates can vary, they are guaranteed not to go below a certain number. And any dividends are secured and guaranteed. They become part of your principal, never to be lost. So again, when we consider the four criteria, safety, liquidity, rate of return, and taxes, permanent dividend-paying life insurance satisfies all four criteria. Your money is safe from loss and guaranteed. It is fully liquid when you use the loan provision. Your money continues to grow and compound at competitive market rates, usually between 4% and 6%. If you are using the loan provision in the policy, all the money taken out in the form of a loan is considered tax-free by the government. So, they are safer, more liquid, have a better rate of return, and you can ultimately use that money tax-free. The solution is in how the policy is designed and structured. Those fees, charges, and expenses are generally going to be about 1% of the total cash value that you have accumulated over the lifetime of the contract. Now, this is where it really gets good. Once you have collateralized that account, you have unlimited access to spend that money tax-free or to reinvest it, all the while still earning uninterrupted compound interest on all your wealth. Let us look at an example. In this example, we are showing someone who is saving $1,000 a month or $12,000 a year. And let's say that at the end of 6 years, they have accumulated $83,704, and they want to invest that money. If they invest their own cash, they would drain the tank and have to start saving that $12,000 a year or $1,000 a month all over again, only to drain the tank again when they want to make another investment. The red chart shows what happens to your wealth when you interrupt the compounding. The green chart shows what happens to the same amount of money if it enjoys uninterrupted compound interest. If you were to add that $12,000 a year to your cash reserves and let it enjoy uninterrupted compound interest, at the end of 30 years it would have grown to over $1 million. But by draining your tank every 6 years and investing that money, you're interrupting the compounding of that wealth, which turns out to be $1 million mistake. So, what can you do with that money? This is where it gets captivating. You can use that money to pay for cars, college, weddings, or you can deploy that capital into productive assets. Let's take a look at how simple it is. Number 1, in order to be insured at reasonable rates, you need to pass a medical exam. Being healthy is a big plus. Number 2, time. You must fund your policy before you can borrow against its value. And number 3, our expertise will help you maximize how much you can put into your policy. You are unique and your goals are your goals. The strategy is simple. You need to work with an expert who understands how to structure your unique infinite banking policy. Our accredited and licensed strategists show their clients every day how to implement the infinite banking concept. We have the ability, along with our preferred life insurance carriers, to position your family's finances on a secure financial foundation built upon sound economic principles. There is no magic to creating wealth. Wealth is acquired through the application of leverage and acquisition of productive assets. The infinite banking concept, along with a tax-efficient use of dividend-paying whole life insurance, will give you the best possible opportunity to compound your savings with guaranteed principal protection. We structure these policies and strategically manage them so that they can become productive assets, giving you the advantage. You're able to create more with essentially the same dollars. When we discuss and teach the infinite banking concept to our clients, we're not talking about losing access to your money for 30 to 40 years. You will have access to your money day one. With the infinite banking concept, you're able to be flexible. You're able to take advantage of the U.S. tax code. You're able to position you and your family's finances so that you can enjoy most of your money today while securing tomorrow and passing on generational wealth. The infinite banking concept is the best, most secure way to capture and control the wealth that flows through your family finances and still have access and control. It is the chief cornerstone of a safe and secure financial foundation. At Everyday Wealth, we're here to educate and to serve. Please get back with the person that shared this video with you to schedule a free, no-obligation private strategy session.